This is Gustavo Chamorro, Director of the Digital Media Center, and you are watching Eye on Business.
Welcome, I'm Kevin McDonald and you're watching Eye on Business. With me today is JJRicha, and he is a serial entrepreneur, a member of the Tech Coast Angels, and managing director for Trenchant Ventures. Thank you for coming in today, JJ. I really appreciate it. So why don't you explain what a serial entrepreneur is, for those who don't know?
What is serial entrepreneur? A serial entrepreneur is a person that is willing to take risk and is willing to take it more than once. In my experience, I have started 6 different companies. First one was really hard to start. Second one was harder, and it keeps going from there. But I've had fun in every one of them.
So just to give the folks an idea of what your life is like now, you know, the Tech Coast Angel, I understand, is a group of small fund investors. What is Trenchant Ventures about?
Trenchant Ventures is a private equity firm. Okay. It started about a year ago, and we look for companies that are in the lower middle market, meaning companies that are under $10 million in transaction value, and they're in distress or they're underperforming. What we do is we look at them and assess their value. If we can buy them at a value price and we see great potential growth, then what we do is we buy them, restructure them according to our experience. We have a great team of 8 people on board right now, and then we sell them.
So slightly different from a couple of the other groups we've talked to in the past. It sounds to me like you're in much more of a bail out, grab the asset that's worth the value, and then continue forward with that asset versus leaving the management team intact and allowing them to continue to go forward. Am I correct in that assumption?
It depends on situation. So again, it's going to be a value buy. So sometimes we keep the management in place, sometimes we keep some of the management in place, sometimes we replace the entire management. But in most situations, what we do is we would like to keep the tribal management or the tribal knowledge in place, so that we're not really completely revamping and creating a whole new business from scratch, because we're looking for businesses that have demand for their service or for their product. So it depends. Each situation is going to be unique, and we're going to be very opportunistic about each business we look at.
Do you see that your opportunity has changed dramatically in the recession, or has it been positive or negative for your position? Last
year, looking at different businesses, it has been we were looking at businesses that were really, really bad, and they're not restructurable. In today's market, we see better companies, and there's the places where you go to find funds are more available right now. So during the 2009, it was really very hard to find the right companies that could be fundable. In today's market, we're seeing better companies, and at the same time, there are more ways to find funds for these companies.
So as an equity firm, it sounds to me like you're doing a couple of different things. Are you providing your own funding, or are you agency? I mean, what is the structure that they can expect when they come to see you?
Yeah, the structure of we have a little bit different structure than a traditional private equity firm. Okay. So our structure is we take we have a fund that we're building right now. We're still in the midst of building the fund. What we do is the fund, we create a whole new entity. And then what we do is we buy the assets of the business that we're trying to restructure or acquire.
That limits the carry forward liability, gives you the freedom to change. I get it. Okay.
That's right. So the fund loans the money to the new entity, and then in return, the fund is first of all is a first in line as a secured lender. Second, they get equity into each business.
So would there be a cash equity for the old business owner, or is it cash out, or does it just vary?
It's going to vary. It may not be a cash out. The owner of the business may get some equity and may stay on board. It depends on each situation is going to be different.
Or debt relief. I know a lot of small businesses would just like to get out from under the history and the credit issues that come from it. So you're with Tech Coast Angels, and you have this other organization. Can you tell me how the decision is made and which venture it would go into? Is it where they come in through the door? Is it the variance of the business itself? What would make the difference in choice there?
Transient Ventures goes after established businesses.
Okay.
So versus Tech Coast Angels, we look at early stage startup businesses. So really, they're completely different. So in Tech Coast Angels, we are looking at companies that very early or somewhat early in their life, from an idea all the way to having some revenues and some customers in place. In Transient Ventures, we're looking at companies that have a sound business model, that have a demand for their product or for their service, and then, but through a series of mismanagement, economy, they've gotten to a point where they cannot sustain running the business, and they have too much debt. They have, it could be a series of many different aspects where we go in there and take over.
So in recent years, I know we've seen a lot of companies that were well run with some cash flow challenges, and historically had been fine because they'd been able to get their credit lines and extended based against their invoicing or whatever the issue might be. And then, of course, when the banking system froze, many of those companies were locked out. So you're seeing probably a significant bit of opportunity right now, are you not?
There's a lot of opportunity out there. But with our model, we have to be very opportunistic because we're trying to find a value buy, and we're a company that has a growth potential.
How difficult do you find it to convince the owner that it's not worth as much as they believe it is, even though they've got their whole life into it?
Well, this is a very difficult question, and it's very difficult for entrepreneurs themselves, especially if someone has had the business for 5, 6, 10 years, and now you're saying we're going to take over. So we expect that we're going to run into some issues with these entrepreneurs, but it's the difference between having the entrepreneur losing the business completely, turning off the lights, and shutting down the business, versus keeping the business, probably saving some jobs, and possibly the entrepreneur keeping a piece of that business.
Credit, reputation, and other things that can be gained as all. Do you see any palpable trend at all in an upward tick at all? I mean, I know the government would all like to make us believe that it's positive out there. We get sort of a mixed sense because I run a technology company, and we've got a very positive sense, but we also know that many of our competitors are not doing so well. So what is your sense of the general market right now?
My sense is that it's still not a great time right now. It probably won't be until the middle of next year at best. Last year we heard middle of 2010, and now we're probably hearing, sometimes some people are saying it's by the end of this year. I think it'll probably drag into next year. So it's still not a great time.
Do you see a double dip coming, or do you believe we're going to stay flat? I mean, what would your personal opinion be on that?
I think, again, you could never predict this, but I think there's no double dip.
Okay, well, it's good to hear. If you were to look at the current market and you were to have to choose today as an entrepreneur what to move into, I know that, for example, we've got a massive growth in the senior population, technology, of course, in the green area. I mean, if you were to give people advice to where to stay away from, let's start with that, maybe the oil business. Do you have any advice for folks? Because this really is for folks that are out there struggling, some of them, and some of them that just have great ideas and want to start a business.
Healthcare is big, and it will stay big for probably a very long time. I think the next bubble is the green. Everybody talks about green energy, green. We need to find a solution, but there's so many solutions out there and so many companies starting around the green. I think it's the next bubble.
You and I are in agreement on that. I also think it has it's the snake oil of the century in some ways, because frankly much of what we're seeing really isn't real. It's just a marketing term and so on and so forth. So healthcare, let's go there for a minute. You see market opportunity, but do you see challenges and limitations with the fact that the government is effectively working to take it over. They got pushed back, but I don't believe the government ever gives up on anything. So, you know, what risk does an entrepreneur have, or even a person going to college today, where their salary limitations are going to apply, there are going to be compensation limitations, limitations on liability, et cetera, et cetera. Do you ultimately think that's a good business to go into in the long run? Maybe not the next decade, but...
Well, when I'm talking about healthcare, I'm thinking healthcare technology or healthcare, new technology, new ways of dealing with healthcare to make healthcare better, more efficient. So if someone could really, if there are a lot of solutions out there that I've been seeing, and some of the solutions make the communication better, some of the solutions make interaction better, make things more efficient. So that type of business will have, regardless if the government takes it over or not, will have a place.
That's interesting you say that, because I know that they're trying to go more electronic transaction. They're also pushing at the same time strict compliance. They've added unbelievable fines for those that violate the HIPAA regulations under high-tech and ARA. And I'm in agreement with that, because I think compliance, for example, in technology that enables that is going to be pretty phenomenal. Yeah. What do you see as a trend here in Orange County? I mean, we used to have the mortgage industry here. And it was substantial. What do you think, or do you have any sense of what's going to be the next bedrock for our economy here?
Orange County has been a technology hub for a very long time. You know, talking about Orange County specifically, you know, I don't know specifically what's the best, but there's a lot of medical device companies in Orange County. You know, San Diego, there's a lot of biotech. You know, you see in LA a lot of digital media type companies. San Diego is a lot of software and a lot of medical device that I've been seeing.
That's interesting. You know, it's funny you bring that up. I never really imagined that the public doesn't realize this, but we hear Silicon Valley is the center, the tech center. And in fact, I helped and proposed ACR 52 that declared California the tech center of America. I don't know if you've got to see that. But we did it intentionally because of the 1 million jobs that are in California that average of $106,000 a year salary, almost half are south of Central California. And most people don't realize that. I didn't know that. So, yeah, so that's one of the things we're trying to do, is to say, whoa, investors, business people, colleges, let's come down this way too, because we have these resources and these great people. Let's talk about your best deal ever and your worst deal ever. Now, you don't have to say specific, but give me an idea of what the range of risk and return can be for a good investor.
Well, I can give you a personal, specific example. I started 6 different companies, and after selling my last company, I started another one, which was number 6, and I invested $500,000 in that company. And believe it or not, you know, you would think that I would succeed at that. I still failed. So that tells you very, very personal to me, where I started another company after starting 5 different ones, where I failed at it. Now, from an angel standpoint, which is really now I'm on the other side of the fence, I look at companies in a completely different angle. Specifically, I've invested in 2 companies so far, and none of them have had an exit yet. So I don't know if I could tell you the best or the worst. But from an angel investor standpoint, I look at companies from a different angle. I look at are they entrepreneur? I look at how viable the business is. I look at there's a demand for their product or service. Do they have any customers? What is their distribution model? How can they reach these customers? Because if they have an easy distribution model, they'll probably succeed if they have a good business model.
You just brought up a really good point, and I think the audience needs to know this. There's a lot of accusation that happens in America when someone does make it successfully. But what they don't see is the $500,000 that was invested. They don't see the fact that you work 18, 20 hours, 7 days a week. I mean, I've been there and I see this. So the other people who don't see it is the legislator. And I'm going to tell you, I have some interviews coming up with some players who can have a difference here in the state of California. So as someone who's investing, what would you like to see in the change of structure as the government's trying to figure out how to get out of this budget nightmare? to bring business to our state and keep them here. Is there any suggestion that you can make to them?
I think in general, if you talk about from a tax standpoint,
Yeah.
so if you see from the taxes when you have the capital gain tax, they don't take into consideration the time, the investment, and the original capital that was invested into the business.
And the deferral of income that you don't take as the owner many times as well.
That's right. Yeah. So if that gets taken into consideration, it makes a huge difference. And they shouldn't put a lot of blocks in front of the angel investors, because angel investors are risking a lot. Mm-hmm. They're risking their capital into businesses that may never succeed. Mm-hmm. So there should be more ways to ease the road for the angel investors in order to invest. At the same time, I just want to bring up another point that you were talking about, the entrepreneurs themselves. Now, the entrepreneurs, they think that I come up with an idea, I start a business, and I'm financially free. But that's not the case. They forget that it takes a lot of work, 18-hour days, 90-hour weeks.
Last one paid, if ever.
Yeah, if ever for. Mm-hmm. So they forget that and it may not work. It may work. So so it's really a lot of work, a lot of risk. They need to understand that they should have some savings, maybe keep their day jobs until the business is launched. So there's a lot of risk, and I would encourage entrepreneurs to go and really understand the ecosystem of the angel investment, of how businesses are started, and to understand better what it takes to get a business from zero to a financially viable business.
Have we seen the pulling back of the unrealistic expectations on valuation? I mean, we saw in the early days, of course, prior to the internet bubble, just completely insane valuations that had no basis. We saw some pullback in the failure, but we're starting to see this again, I think, in the green environment. There's no income, there's no proven revenue model, and yet somehow they have these huge valuations. How do you manage the expectations of an entrepreneur that comes up and goes, I have this billion-dollar idea, I know it's going to make it, and you're going, you have no revenue, how do you argue that position?
What you do is you value the business based on today. Mm-hmm. You don't value it based on its potential revenue in the future. Mm-hmm. So do you have any sales, any revenue today? If you do, then we decide basically, well, it has so much revenue, and there are many formulas that you could go after. But you look at the business today, you look at the risk of the business success, and then you decide what the value is. But you can't value it on $1 billion potential revenue. Right. And then you look at how much can this business grab out of a $1 billion market. So if a business can grab 5% of a $1 billion market, then they might have a better chance of succeeding or getting to maybe $50 million or $100 million type mm-hmm. company. And so it's all based on the current revenue and the potential market, and how much risk is it to grab that market.
So how much of the valuation in today's is the management team? I know that many organizations brought people unrelated to the entrepreneurship part of the family, I guess yes. you could say, in order to raise funds. How much of that is still going on today? Are there hired guns still being brought into companies just to raise funds? There always are, but we look at the management team. So actually there's a controversial email that I sent around to Tecos Angels just a couple days ago. Mm-hmm. Is it the jockey or is it the horse? Mm-hmm. Which one do we bet on? Mm-hmm. Well, it's a controversial subject. Some of the Tecos Angel members say it's the jockey, and some say it's the horse. So I got a pretty hot conversation going on. But there was a study done by several universities, including USC and Chicago, University of Chicago, that says it's the horse. So for me, it's really both, and it may be a 50-50, split. Because if you don't have a good business model, no matter how great the management team is, they're not going to be able to take that business. If there's no commercial desire, if you don't have the finance capability, I can understand where your point comes from.
And the same thing, if you have a great business, but there's no jockey to take it to the next level, it's also not going to work. So it's really both. But initially, you're going to look at the management team, how enthusiastic they are, how much do they understand the business, if they've done it before, even better. You see some management, they've never done it before, but they have the right idea and they know they can execute.
Do you still expect the owners or the original investors to have been slave to their credit cards and fully in debt? I mean, I've seen this over the years, that until you show us that you've spent everything you have, basically, we're not interested. Are we still seeing that in the market today?
It's even more now.
Is it? Okay.
Yes, because valuations are down and investments are down. So, average Tecos Angel investment was probably, let's say, an average of 750,000. Now an average of probably 300,000, maybe 400,000.
It is a substantial change.
It's a substantial change. So we're looking for more validation.
On that same level, then, does an entrepreneur need to come with revenue? Are you taking pre-revenue companies? And at what point do you make the decision, yes or no, on that basis?
Tecos Angels, well, we have a program called Seed Track at Tecos Angel. Okay. So the Seed Track program really takes pre-revenue type companies. And these types of companies are companies that are valued at somewhere around $500,000, and they need less than $100,000 to prove their concept. Okay. So they don't need to have revenues. But there are not many companies that fit that profile. So most companies that Tecos Angels or angel groups in general invest in are companies that have a proven model. So they have some paying customers, maybe a lot of non-paying customers, but it's basically, we want to know if the dog will eat the dog food. So if there is a demand for that product or that service, and there is proof for that, regardless of how much revenue there is, it could be small revenue, but at least we know there is a demand.
So post-revenue, then, I think when you come in, are you coming in as an accelerator more than a base investor? Is that kind of the concept you're looking for? We know the machine's on the track, it's ready to go. I know many companies are short of basics like marketing and R&D money. What's your primary experience, and what is it that money is funneled towards as you move into?
In the Seed Track type program, we actually get involved personally into the company. So we will actually help them take an executive position in the management and help them get to the next level. So that's kind of part of it. In the general Tecos Angels, we take a position on the board of directors of that company, but we don't really actually take active management control or management position into the business. But to tell you the truth, what happens is nowadays, most of the time you're going to see companies that are requiring money, and if they don't have a proof of concept, then they're probably not going to get investment from angel groups. So you got to have some proof of concept in order to really get some capital.
Now, do you see beta as proof of concept? I've heard this argument that if you've got a university or a large business that's willing to integrate and spend a couple $1 million to run an across-the-board beta test, even though they're not paying for it yet, do you see that as the same value, equivalent value, any value? I mean, does it make sense for someone to try to get a beta test going?
It really depends. And I could tell you one example that was presented to me not long ago. It was a company that received somewhere around $15 million in investment from foundations, from the federal government as grants, and they were still an R&D type company. So they did not have a plan for how to sell their. It was a pharmaceutical related. So they did not have any plan.
It sounds like the government. I'm not surprised.
So it was. They did not have a business. They had, but it's a great concept. They were trying to cure. Certain cancers, but at the same time, they did not have a plan on how to reach
It's that conversion issue, right?
It's that conversion. How do you convert from being a lab into being a real valid business?
So in the couple minutes that we have left, tell me a little bit about the profile of an entrepreneur, if you can. I mean, what do you think it takes in today's world to become an entrepreneur?
Tenacity.
Okay.
Persistence. Taking risk. Maybe that's the definition of an entrepreneur.
It could be. Do you see education as a challenge in today's market? I mean, I know that many of the super entrepreneurs I've known don't have college backgrounds and are the most successful. But in today's market, with technology and some of the advancements, do you have a minimum floor that you look at, or is it totally based on the business that you're talking about?
Well, the super entrepreneurs, I probably know who you're talking about, but you got to have some floor, I think. Without having some education, you probably won't be able to reach certain levels. But as you noticed from my minimal definition, I didn't mention education. But education, I think it's important, very much.
Well, I want to thank you for taking the time. I think that the audience and I certainly did get information that's very valuable, and I really appreciate your coming in, and I hope you'll come back sometime in the future.
Thank you very much.
Thank you so much, JJ.
Have a good day.
I'm Kevin McDonald, and you've been watching Eye on Business.